All right, everyone. Thanks for joining this brown bag. So today's brown bag is called the 1, 2, 3s of price action. So what we'll be talking about today is a fairly uh, trading specific topic. So I've been studying price action for the last 15 years. I got into trading about 15 years ago, and price action was something that really caught my attention right away, especially when you first get into trading. You don't know too much about fundamentals. You don't know too much about quantitative stuff. So most people start with the charts, and that's kind of where I started as well. And so over the years, I've explored many different variations of visualizing data. That's what charting is, and price action is the ability to visualize and perhaps recognize uh, patterns in charts. And after studying, all these different methods, in the end, I kind of found one method which I thought resonated the most with me because it was the most, or let's say, the least subjective in nature. The problem that I found with most price action, all the old school stuff like heads and shoulders patterns and wedges and flags and all these different types of patterns, is that they're very subjective. You show one pattern to like 5 people, and then you have like 10 different 10 different patterns. So it's never like subjective, and you can never even technically even objectively try to code it, like to try to put it into some sort of um, logic that you could actually find these patterns and actually try to actually back test them. So in the end, I thought it was very subjective and very difficult to trade off of because of that subjectivity. So when I found this method, I thought this is probably the first method I saw that made the most amount of objective sense, where you were not overlaying any personal opinion. And if you've been trading for any period of time, you understand how important that is, because as soon as you begin to introduce bias into your trading, it can get very dangerous very quickly. So this method I'll be sharing today, I call that this presentation is called the 1, 2, 3s of price action. And basically, it's just like that. These are basically price action. You can think of them as Lego blocks: 1, 2, and 3. These are different scenarios that is possible with price. And this method was popularized by a former trader named Rob Smith. He's a bit of a wild card. His methods are a bit on the I guess eccentric side, but nonetheless, the method itself and the way that he sees price is definitely something quite, I think, quite unique and quite profound. So that's what I'll be sharing today is sort of this method. If you Google, and I'll share some resources at the end of the presentation. If you Google the Strat by Rob Smith, Strat as in short for strategy, that this is kind of this is what I'll be talking about today. And before we get into the actual presentation, this again is not financial advice. In order to create a profitable trading method or system, you need to do a lot more than just simply apply price, in my opinion. So this may help you with your analysis of whatever asset you're looking at, but certainly if you want to have a fully a robust trading method, then price is probably just one maybe one component of that system. But this system, I like it a lot. I guess not system, but this way of visualizing price, I like it a lot. It's so easy, in fact, that I hope that by the end of this presentation that you'll be able to spot the patterns yourself, because they're not really patterns even. They're just basically ways of just labeling price. And it's so simple that I've actually taught this to my kids. So I have a 10-year-old and a 7-year-old. And a couple of years ago, I thought, around 5 years old, I think I could start teaching my daughter this. And yeah, I was able to start teaching her the basics of price action. And to this day, we still, when we have time, we pull up a chart and I get them to describe to me the different price action patterns. So becomes quite the fun little family hobby. So that being said, let's launch into things. So essentially, here's the agenda. We're going to talk about the price action scenarios. And as I've kind of alluded to in the title of the presentation, there are actually only 3 scenarios that can ever possibly happen when you look at price. Understanding reversals, the importance of understanding how to kind of find price reversals, applying multiple time frame analysis, and then finally I'll put it all together by giving examples. And I'll try to do that throughout the presentation. I won't just look at boring static screenshots. We'll pull up TradingView and we'll talk through some of these scenarios. And feel free to to ask questions or to, if you want to look at a certain symbol or token, we can pull that up as well and apply the same method on it, so people get a chance to use it. So it's one thing to understand it, obviously cognitively, but the the mastering of any topic only comes from the repeated usage of it. So let's launch into it. So first off, this is kind of where I first began when I first started looking at price action patterns. If you open up any kind of Japanese candlestick book, there's like dozens of patterns. Just this chart alone has about 30 patterns, right? And so most traders, when you first get into this stuff, you're like, oh man, I got to learn all these patterns. There's like 30 of them, and you got to try to put them to memory. And that's kind of what the old school way of trading was, right? You got to try to memorize these patterns, and then you try to find them on the charts. And I think it's it's a bit archaic, because what you're doing here is that you're actually not understanding the actual mechanics or fundamentals of price. All you're doing is memorizing a pattern. So what we're going to be doing is actually deconstructing these patterns into their basic elements and understanding what each bar means. So when I see like, let's say, a 5 or 6 bar pattern like this one here, a shooting star, what exactly is that telling me? Yes, it says it's bearish, but why is that bearish, right? And it doesn't tell you that. If you actually understand each single bar, then you'd actually understand what's going on there and the importance of that. And then if you actually overlay, let's say, multiple time frames on top of that, then you get even a deeper picture. And what we're ultimately doing is you're trying to find and understand the different participants that are getting involved at the different areas of price. And that's kind of what understanding or reading charts is all about, right? Is not just trying to predict price, because I think that's a fool's errand or a fool's game. The idea here is to understand price action to the extent that you'll be able to respond and not react to price. So given a certain set of scenarios, you have an expectation of how it may play out, and you get yourself ready for that scenario. Versus something happens, and you freak out and you react, and that's how you lose a lot. That's how you lose a lot of money. So let's go to the next one. So again, today's presentation, I'm not going to be talking about trading setups or how to enter into trades and that kind of stuff. This is simply a examination of how to look at price. Okay, so let's get into it. So just by a show of hands, or whoever wants to chime in, who here has looked at candlestick charts before? Just want to make sure we're on the same page. Like, yeah, Jamie's got his hand up. Andrew's there. Oh, welcome, Andrew. So you guys want to know what candlestick charts are? The rest of you folks, Leonie, great. Do you know what candlestick charts are? Trick question? Not always a trick question. Some people like looking at, some people like looking at bar, not bar charts, but they like looking at just either line charts or just your classic just high-low charts. So, but this method does use candlestick charts. So I'll just quickly go through a short definition, so we're all on the same page here about what a candlestick chart is, because it's certainly, we're looking at the whole chart, a whole candlestick, and not just the highs and the lows, which is something that some people do. And whatever method works for you. If you can find an edge, that's what's most important. But in this method, or in this way of looking at price, we are using candlesticks. So just to make sure we are all on the same page here. So, a candlestick is comprised of four components, right? Open, high, low, close, OHLC. So the open is where the bar opens, obviously. The high is the high bar of the, high bar of that range, or high tick of that range. The low is the low of that range. And the close is wherever it closes based on that time scale you're looking at. And the opposite is true for a red candle. Red candle means it opens. At some point, it trades higher. At some point, it trades lower. And then eventually, it closes wherever it closes. So just, when you're thinking about candlesticks, just an important thing to remember, this is very basic stuff, but just want to make sure we're grounded in the elements of it, is that the interesting thing is that we don't know exactly what order this happens, right? We don't know if it opens and goes low first and then goes high and then closes there, or it opens and then goes high first, then goes low, then closes there, right? So we don't know the order or the sequence in which that happens. So intraday or intra-bar, you may see a situation like this where it's going high, low, high, low, high, low, right? And then finally closes there. Or it could be one smooth move where it goes open, high, low, close. So that is what you cannot see by looking at a chart like this, right? Or at a bar like this. So this is the importance of oftentimes looking inside the bar, and that's what we're talking about when we start looking at multi-time frame analysis, because I don't know what's inside this bar, right? Can't visualize what's inside, the sequence of events or that path that the bar took intra-bar. And this is why it's important sometimes to see what happened inside that bar so we can get a better understanding of the real meaning of this bar. But we'll get more to that during the multiple time frame analysis portion of things. So that's the basics. So now we know what an open is, we know what the close is, we know what the high is, what the low is. That's now the basics. So getting to the actual scenarios themselves, here's the big revelation of this method of looking at price. Price can only ever do one of three things. This is universal. So price can only ever do one of three things. So let me share with you the three things that price can only ever do. So once you get this, you realize there's only three applicable scenarios when you look at a candlestick chart. The first scenario number one, is called a classic inside bar. Scenario one is an inside bar. So basically, underneath these inside bars, I put the number one. We call these ones, right? So an inside bar is anything where the current bar is inside the range of the prior bar, otherwise known as the mother bar. So it could be a big green bar, and then you have a bar that is, lower than the previous high or higher than the previous low. And that would be the inside bar. Same thing, could be a red bar, so long as the current bar is lower than the prior high, or this bar's high is lower than the prior bar's high, and this bar's low is higher than this bar's previous bar's low. Yeah, Jamie, you got a question or a comment?
Yeah, I just wanted to ask, is an inside bar is determined by the high and low, or is it by the body of a candlestick?
This method is high and low. Some people say it's the body, but I think it's more pertinent to say I'm of the opinion that the high and lows matter, because price does transact at those areas. So I think that the purest definition, I think, and the one that I worked off of, and most people do, is off that high and low, because there actually are transactions that are happening there. So not just the body.
Okay, cool. Thanks.
Yeah, no problem. So we call this scenario 01. So what's important about an inside bar? So, inside bar or scenario 1, what's important about it? Basically, think about the market or the way, assets move. We always are moving, or it is always moving in kind of two sort of waves, a contractionary wave and then a range expansionary wave. So that's kind of how price typically works, right? You see periods of contraction where it's kind of range bound, and all of a sudden you see after a large range bound situation, then price then tends to expand. And so the scenario 1 captures this inside or range bound situation, right? So just to be very specific, some people might even say, going back to James' question, some people say, well, if the one high is exactly the same as the prior bar's high, that could be an inside bar as well. But if you want to be very, very specific, it needs to be lower. So could just be one tick lower, should not be equal. So that's just a very small thing. But if you're interested in programming these things or want to get the technical details, then that stuff doesn't matter. But back to the fundamentals. So why does it matter? Because when you see an inside bar, anytime you see an inside bar, it means it's a contractionary period. And so after a contractionary period, you tend to expect some sort of range expansion, right? And the longer you have a range, as you may have recognized in markets or in other assets, the longer the range, usually the bigger the breakout, right? So if we have a huge long range, let's say a day range, then price may expand for 2 days afterwards or more. If it contracts for, let's say, a whole year, like we've seen in the past with Bitcoin and Ethereum, then things get very wild, right? Because then it's been contracting for a year. People have fundamental news that they're digesting, and you have two different sides that are kind of finding a balance. That's basically what an inside bar is, or a range is people having a disagreement on whether things should go any higher or lower. There tends to be an equilibrium for a period, and then finally, once there's some fundamental news or macro news that causes a substantial breakout, then people are forced to then concede that one side is right, and price then tends to move in a direction linearly for a period of time. So that's the scenario 1. Let's talk scenario 2 now. Scenario 2 is just that, a directional move. So a directional move is very straightforward. All it means is you have the current bar takes out the prior bar's high. So if it goes up, that's called a 2 up, scenario 2 up. If it's down, it's a 2 down, right? So scenario 2 down. So you can see here from the red, on the red side, the last bar there, the low is lower than the prior bar's low, but its high is not higher than the prior bar's high, right? So we have a lower low. That's a 2 down. Same, the opposite is 2 up, right? The high is higher than the prior bar's high, but the low is not lower than the prior bar's low. So simply put, this is a directional move, right? So it's a directional move going up or down. 2 up goes up, 2 up, 2 down goes down. Okay. Again, feel free to stop me if I'm not clear or I'm going too fast or even too slow. Lastly, scenario 3. This is the last of all the options. This is all you need to remember. 1, 2. So 1 is inside bar, 2 is directional, 3 is now an outside bar. This is actually the most interesting of all the scenarios. And this is your range expansion scenario. So when you see this type of scenario, this is the one that most people do not understand or don't study. And this is where most traders get crushed or get really hurt because they're not prepared for this kind of scenario. So what's an outside bar? Technically, what all it means is you've taken out both sides of the range. You've taken out the prior bar's high and the prior bar's low. So what's interesting about a 3 or scenario 3 is that once a 3, it's always a 3, right? So once you take out both sides of the range, it can never be a 2 again. It can never be a 1 again, right? So that's the significance of a 3 bar is that an outside bar is always an outside bar. It will never be anything but an outside bar. And the outside bar is very, very important because it shows there's actually some aggression going on in the market. That means you have buyers and sellers on both sides being aggressive because you've taken out both sides of the range. So as an inside bar, we saw this equilibrium, and that means the buyers and sellers are kind of met in the middle. Whereas an outside bar, we're seeing both sides get involved aggressively, taking out both sides of the range. And so typically that means some people are getting stopped out in traditional markets, right? As you break lower, some people go short and they put their stop at the bar's high, the prior bar's high, and all of a sudden price comes whipping back and takes out the other side of the range, and that stops the shorts out. And then that might cause people to chase and buy the prior bar's high, and then it's a kind of a momentum move to the upside. And we'll see that in our examples shortly here. One final thing to comment on, so that's kind of the psychological stuff that's going on behind the scenes with these outside bars, is that what we're talking about here are people getting stopped out. And this is why it's an important bar, because folks are getting stopped out. Imagine if you're short, if you have this inclination to get short and you sell the prior bar's low because it breaks and you're like, okay, the market's going to break down now, and all of a sudden it comes whipping out the other side and takes out the prior bar's high. Where do you get out if you're short? Right? So people who have very tight stops, they'll put out the prior bar's high and get out right there. Otherwise, maybe you put your stop, higher up. Maybe it's an ATR-based stop or some sort of price action-based stop, and you put a few ticks higher. Once it starts going against you, now you're worried, right? Because like, man, this doesn't look good anymore. At a certain point, this turns into short covering, where the folks who are short now have to begin to get worried about getting stopped out. And then if they do get stopped out and this thing keeps going, they're gonna have to get back in. So now they're even wrong about getting short. And now you often see with these kinds of moves is you can actually have a strong momentum move that carries forward. But that itself leaves poor structure behind. We're not going to get a chance too much to talk about market structure today, but these bars also reveal a lot about market structure as people are chasing typically here, because these people who got stopped out are now emotional. If they chase now and get back in, once again, those who chase, they have poor trade location and oftentimes are the first ones to be the weak hands to get stopped out on another reversal. And that's what frustrates most traders, because they don't see these patterns, understand what's happening fundamentally with each bar. So I'll layer on one final piece here, and I don't know if we got a chance to talk about it today because it does get a little complicated. But the one last thing I'll share today is the outside bars. These threes, scenario three bars, are also very important because they're actually on a fractal basis a broadening formation. So I'll share maybe if we have a chance what that is, but the market basically moves in sort of broadening formation type patterns. So that means you get higher highs and higher lows. So most people, when you learn technical analysis, you've always taught that trends are supposed to be like a series of higher highs and higher lows. That's how markets work. And then all of a sudden you get a higher low and a higher high, and markets keep going up, and people get stopped out and you can't figure out why. It's because the market's not smooth like that. The market, the way it really works is it's a game of liquidity, right? People chase areas where they know there's liquidity. And so this is often why you get price taking out higher highs and lower lows, and it keeps moving in the direction of the trend. But in the meanwhile, folks who've been programmed to only believe in higher highs and higher lows, or lower highs and lower lows, they're getting stopped out on these, what they think are whipsaws, but in fact, what they are people hunting for liquidity, because that's the way that price actually works. That's what price is the market's basically an auction mechanism to find liquidity. So the outside bars capture that, and they capture the higher highs and the higher lows. So if you see a higher high and higher low, like a higher high here and a lower low there, if you look at a different time scale, you may find that it's actually an outside bar. So maybe we'll talk about that later on if there's time, but very, very important on understanding price. So let's do some examples now. So yeah, let's bring some examples up just to give you some real world flavor. So let's share my my screen really quickly here. I'll share out my trading view. Okay, I'll share my trading view. And I've been posting in the Speculate Discord room, some of my charts on Bitcoin. So I thought I'll just do that. We'll just share that chart here, and we'll just talk through that chart now that we understand the 3 different scenarios. So all we'll do here now is just look at the last, let's say the last 2 weeks of price action, and let's just the mythical Houston chart. Let's just just basically understand each bar by bar and apply our labeling to it. Okay, so we'll begin here. So I've made I give myself a little cheat. I paint bars that are outside bars with red diamonds, and any bar that has a little blue diamond is an inside bar. So essentially what we're looking at here is, let's start from right here. Okay, so August 14th, we have an outside bar, right? So this high is higher than that high, and that low is lower than that low. So that's a 3. Yeah, Jamie, shoot.
Yeah, I'm just wondering, is there like a certain indicator on TradingView you used to do that, or did you just create that yourself? Or
I created these myself because when
Okay.
I first found this method, it was before TradingView got really popular. But now you can find it quite easily in the resources later. I'll share with you. Yeah, exactly. No problem, Lee. Yeah, I'll share with you some links where you can find the TradingView indicators. Yeah, nowadays there's tons of people who've created them in TradingView, and they're all free. So yeah, no need to pay for them or anything like that. So there you go. So there's your outside bar. So that's a 3, right? Next bar, a 3. So 3, 3. What's happening here? People are getting stopped out left, right, and center, right? Some people are buying, right? They buy the prior bars high, thinking, look, it's a breakout, right? People always think people always buy breakouts. They think that's a breakout, comes in, and then it fades back down again. And these guys who have tight stops get stopped out. There's your outside bar. The next day, another outside bar. That's a 3. So this is a lot of pain for a lot of people who are trying to buy breakouts, right? Once again, they're like, oh, I get stopped out, but the price makes a new high again. And then they buy again, and then price goes back down, and they get stopped out once again. So there's 2 up. Okay, so 3, 3, right? So we understand that. Now this is a lower low. That's a 2. So 3, 3, 2. Another 3, right? So this is people are getting crushed in the sequence because both sides are getting involved. And if you don't know what you're doing, and you're buying breakouts, you're getting crushed here. 3, 2, down, right? Here's another 2 down, big 2 down. Remember back in August, that was a good 10% day down. Then green day, but still a 2 down. But it was green day, 2 up, 2 down. So right now I'm not doing any analysis. I'm just reading it as is, so you understand how I would read the chart and how this method reads the chart. 2 down, 3, 3 up, 1, 3 down, 2 down, 2 down, 2 up, 1, 2 down, 2 up. Right, so that's kind of how I would read that chart. So right now that may sound just a bunch of like, it's just a bunch of random numbers, but you may find out, like, once you do this stuff long enough, you realize there's actually a pattern. There's actually patterns around you can put these together into like a little Lego block, and you begin to see that there are certain scenarios that are quite interesting. For instance, and I'll talk about this later on, but a 1, 2 down scenario, all it takes is a 2 up to then put that pivot in play. So something like this would be interesting. A 3 is an outside bar. It goes 3, 2 up. As soon as price comes back in here, you begin to expect there's a possibility for it to come out the other side. And so you get prepared for these things to happen versus, being completely taken off guard when all of a sudden price starts to act in a way that you're not expecting. So once you break down each bar and you see them long enough, you begin to build a kind of a mental model of how things can work around certain areas. Okay, so that's I think that's enough for the live samples for now. We'll get deep into the charts later on. I'm just checking the chat or the questions, if any questions around how we're defining the bars. Any questions around the 1, 2, 3 arm? If you get that, then you're nearly halfway there. Let's say quarter way. Now it's time to get more interesting. Okay, so let's go back to the slide deck, and now we'll begin to add a very important component, and that is around understanding reversals. Because unfortunately, most people, when you're first taught trading, most people are self-taught in the beginning, at the very least. You're taught breakouts, and breakouts, and most people figured it out over time. This is different. Like it's interesting, right? When you trade breakouts, there are certain periods of time where it works very, very well in the markets. It tends to work very, very well, interestingly enough, and maybe not coincidentally, is when the market's very nascent, right? So it was easy to trade breakouts like in 2017 for crypto, right? Because the market was in a big bull market, and it's also a very nascent market. So you didn't have a lot of people who were very savvy at the time, and so you could actually buy breakouts to good effect. Likewise, the halcyon or the golden era for trading breakouts in the stock market was like 40 years ago, like in the 80s. People were trading breakouts like crazy back then, and that's because at that time charting was very new, right? So charting, they didn't have a lot of tools for charting, and when people finally got charts, they could see these things themselves without having to do it by hand on paper. They find these little areas where they could say, yeah, I kind of see this as kind of a horizontal line here. If it breaks above that, it's a breakout. Unfortunately, or fortunately, just the way things work is that if everyone's seeing everything the same way, then the game theoretical approach is to actually fade that move, right? You actually want to take the other side of that because the boat is too heavy in one direction. So the professionals, once they come in, they understand the pattern very well, and they tend to fade breakouts, especially if there's no new macro news involved, as well as other technical factors. So they tend to fade breakouts. So anyone who's trained to trade breakouts, your system probably incurs a lot of losses, but you might have a few home runs that you really need to ride to offset those losses, right? So trading breakouts is a very difficult game. I guess that's a very a long way of saying trading breakouts is a very difficult game because most of the time it's going to fail, and the time it does work, you have to let it run and try to ride the trend as long as possible. But as you guys all probably know, if you've had like 6 failed trades in a row, and you get to the 7th and you finally get a winner, you're probably going to be gun shy. You're probably going to want to, human nature is to cut that winner short and just to get a bit of money because you've lost so much already. Fortunately, that's not the right behavior, because in that method of trading, you really have to try to ride the winners as long as possible, but that really overrides every single human nature that we have. So what I'm trying to say here with this setup is that the most important thing is not to necessarily not trade breakouts, but to understand that that they fail for a reason. And so why do most traders lose money? And it's one of these basically one of 3 reasons. Most traders lose money, number 1, because they get chopped up in a range, right? And that's basically scenario 1. That's what we just talked about. So if you ever see, if you ever went long and then it went against you, you got short, and then it went back up again, you got long again, and it went back down, you just got chopped up whipsawed both ways, that's because you're probably trading in some sort of scenario 1. So whether you know it or not, if you were to look at the right time frame or time scale, you're probably trading in a range, and it's chopping you up. The second reason most traders lose money, number 2, they're fighting a trend, right? So you're trying to go long, but unfortunately the trend is is bearish, right? So you're fighting a trend. That's a scenario 2. So imagine you're fighting a 2 down, right? The price is going 2 down. Let's say on the monthly chart, you keep trying to bottom pick it by buying on the daily chart, and you're fighting this trend all the way down. And you keep losing money because you're fighting a trend. And the last reason traders tend to lose money, you can probably figure out now, is scenario 3. Because you enter a trade, it works a bit in your favor, then all of a sudden it retraces the entire move and it goes back to where you got in, and it even goes lower than that. And that's scenario 3. And so whether most people know it or not, that's how most people lose money, is they don't understand what scenario is currently playing out in their current time frame they're operating in. So knowing this doesn't necessarily make things any easier to trade, because trading is a difficult game, but at least you understand like where you're going wrong, so you can take the right action sometimes, right? So for instance, you may understand that, hey, I have a breakout system, right? I trade breakouts. Now, if you recognize that you're in a scenario 1 situation, you probably shouldn't be trading breakouts. It's just not the right environment to be trading breakouts, which is very important, right? So this is why you do want to understand these scenarios, because at least they can identify whether your system, whatever method you're using, is the right method to use at that time. So if you're trading in a range, scenario 1, so let's say it's a weekly range. You're looking at a weekly chart and it's a 1, and it's right now the price is trading right in the middle of that range, and you have a few days left before that week closes. There's very little chance it's not going to be still a 1 if you only have 2 sessions left, right? So your bet, if you're trying to play breakouts, is that somehow things are going to change in 2 days and it's not going to be a 1 anymore. And so the mental model in your head is, you have to be weighing those probabilities. Like, is it really possible or probable that you're going to break the scenario 1 situation with this breakout that I'm playing now? More than likely, it's not going to happen. And so the best, alternative, or the best choice for you at that point is probably not to try your breakout trade if you understand you're trading this scenario. Better yet, if you have some sort of mean reversion system, all right, so understanding that you can use different methods based upon the different scenarios you could be trading in, you may want more of a mean reversionary system to take advantage of this range bound scenario. So if you get high in the range and it looks like the range is going to probably hold, if you have a mean reversion type scenario, you can sell the high and hopefully get price back into the middle of the range or the lower end of the range. If you're in a scenario 2 scenario on a higher time frame, let's say you're in a bull market and the monthly chart is looking super green, it's going 2 up, and everything's going 2 up, everything's green. Yeah, it's breakout time. Let's do it, right? Try to find breakouts after some consolidations in a bull market. There is no better time to buy breakouts than in a bull market after a bit of consolidation. And lastly, scenario 3. This is the tricky one. This is where you sometimes just need to maybe even step away to make sure that you don't get lured back in. If you get that outside bar, then it's very difficult to understand what could be the next bar. And so at that point, you may, on a higher time frame, again, let's say your main time frame or time scale of operation is the daily chart. You're only doing, let's say, swing trades, that kind of stuff, kind of shorter to midterm trades. Then if you have an outside bar on the weekly chart, as an example, and the week's set to close soon, remember, 1 to 3 hours of 3. So you may not want to get involved until you see the next bar on that weekly chart. Now, that's a lot of stuff to digest there, because there's no visuals, but we'll talk more about that. Well, I'll show more about that stuff when we get to the live examples. Okay, so let's get to understanding reversals. So why do we understand reversals? So this is kind of the opposite of trading breakouts, right? So if you trade breakouts, then you're always looking for higher highs, but we know that's not always a good idea. Instead, understanding how price can reverse gives you the opportunity to get in earlier if you want to use this as a trading entry method. Or secondly, it just allows you to visualize potential tops and potential bottoms. And and you can definitely see the benefit of being able to see or spot a top. If you start to see a bottom forming, then you may want to begin and get ready to enter in longs. Likewise, if things look toppy and you have a scenario where you have some poor price action, this is where you may not want to be entering into new long positions. So let's talk about reversals. And just like we talked about before, what's interesting is that price can only ever reverse in one of 3 ways. So we know scenario 1, 2, and 3. Price now can only ever reverse in one of 3 ways. You have a 1-2 scenario. So that could be 1-2 up or 1-2 down. You have a 2-2 scenario. That means the price goes 2 down, followed by a 2 up or 2 up, 2 down. don't worry, I'll share with you some samples in a second here. I'm just describing it now. Or price can reverse by going 1-3. You have 1 bar, and it goes 2 down, and all of a sudden it goes 2 up, and that turns into a 3. So that's a 1-3 up. So what's that look like? Here's a 1-2 reversal, right? A bullish and a bearish example. So on this example here, on the one, the top one, the bullish reversal, let's say you have price going down. You have that a 1 bar now, and then it breaks to the upside. It goes 1-2 up. So price had been going downwards. Then you had a big white bar. Then the colors don't matter that much actually. So I won't focus on the colors as much. Just look at the numbers themselves. Then you get a 1 bar, and it goes 2 up. Is your bullish reversal. Bearish reversal. Price is going up. All of a sudden you get a 1, and then you get a 2 down, and that's would be a bearish reversal. A 1-2 reversal. A 2-2. Okay, so the first one's bullish. Price is going down. It's in a downtrend. All of a sudden it goes 2 down, 2 up. Don't worry about the targeted entries. That's, again, I'm not talking about trading entries today. We're just talking about describing price and describing reversals. Bearish is a 2 up, a 2 down. So imagine, you have a big uptrend going. It's going 2 up, 2 up, 2 up, 2 up, and all of a sudden it goes 2 up, 2 down. There's your reversal. The last one, 1-3 up, 1-3 down. So the first example, once again, let's say your price is in a downtrend, and all of a sudden it goes 1, and it starts off as a 1-2 down, looks really, really bearish, and all of a sudden turns from a 2 down, and then it goes all the way back up again, turns into a 3. Now it's a 1-3 up reversal. The opposite, 1-3 down. Imagine you're in a big uptrend, price is going up, 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 up. Does a 1, it goes 1-2 up. It looks like we got a fresh breakout, new highs. All of a sudden the bears come in, the sellers come in, they take it right back to the range, causing a 1-3 down. And there's your last reversal there. Okay, so there's only 3 reversals. That's all you need to remember. Those 3 there. 1-2, 2-2, 1-3. And that's the only way that reversals ever happen. So if you don't believe me, let's now get some examples. So let me share out my trading view once again. Okay. Okay, so I'll stop sharing. And while I stop sharing here, let's look at the screen, see if there's any questions. No, we're good. So let's share this out here. Okay, so we're back to our Bitcoin chart. So let's do Bitcoin. So let's look at the most recent reversal that happened here. So we have a 1, a 2 down, right? And you get a 2 up. So that's technically a reversal right there. 1, 2 down, right? Some bears shorted this. They went 1, 2 down. Sellers thought it was going to go lower. And what happened? The next day, that's today, it broke above the prior bar's high. And now the guys who sold down here are in trouble. And so this, just from a liquidity perspective, if you got short here, where are you going to put your stop? Maybe there if you're really tight, maybe there if you want to be less tight, maybe somewhere else if you want to have a large, a larger stop. But ultimately, the guys who have the stops right there, that's the first pivot that people are chasing after right now, right? So that pivot there, the people are chasing after, right? So that's a 1, 2 down, and now reversal because it took out this bar's high. So 1, 2 down, 2 up, okay? Or sorry, this case it's just a 2 down, 2 up, but this is the 3 bar combination I'm talking about here. A 1, 2 down, 2 up. This is a 2 down, 2 up reversal. Here another one, 2 down, 2 up. Again, these are not making new lows, right? So this is this 2 down, 2 up has been the bottom of August, right? So went 2 down, 2 up right there, and that bottom so far has held into the month of September. Now, who knows if that low holds or not? That's it's hard to say, but I'm just talking reversals of this time. Okay, let's see the one before that. What's the prior reversal? Happened here was 1. Right? People thought it was going to break out. They went 1, 2 up. All of a sudden, it goes 1, 3 down. Right? It takes out the prior bar's low. It turns into a reversal. So anyone who got involved here thinking, hey, this is a good time. I think it bottomed and it's going to go like this. Right? Well, the price action was warning you. If this low gets taken out, you have to watch out. All these pivots are going to come into play. Because everyone knows that if you bought anywhere here, what's the max pain? That's what the market likes to do, right? Is invoke max pain. They're going to go after your stops. And the max pain is to take out all these folks here who got involved at the 19 or 20 low there. Okay, so that's that reversal that happened there. So it went 3. So let's count it out here, right? So it went 3, 2 up, 1, 3 down. So that's an interesting pattern. So I'm just talking this through now. So 3, 2 up. So what we know about the 3 is that that's aggressive, right? Meaning it took out both sides of the range. So the folks here who try to get short, because this bar technically did break below that bar there. Some folks thought that when price is moving up here, that they were going to short this on this bar, and price is going to fall down like this. Unfortunately, they got their timing wrong. It happened here, not here. But they tried. Some folks tried right there when it broke below that bar's low. Unfortunately for them, right, they had really bad timing, and price quickly went out the other side. And so for a while, let's say you got short at the bottom of this line at 20,908, took a short below that line, hoping for some sort of breakdown. Price goes outside bar against you, goes to 3 up. So where do you get out here, right? So let's say you're like a very tight stop kind of guy or gal, and you put your stop right there. Well, that day, price goes right against you again and stops you out at 21,537 area. So you get really frustrated, right? You're like, oh man, I can't believe I got lured into that. I bet you it's going to go higher now. But maybe I should wait a day. So you wait a day. It goes higher. And now anyone who didn't get stopped out here today, you may have got stopped out on this bar. And so finally, your people are like, oh, I got to get back in because probably it's going to go back to all-time highs now, right? Or something crazy like that. So then people buy. So they buy on this day. Maybe they put their stop there, right? They put their stop on the day of the outside bar because that's that's a low, that's a pivot. And so they buy. I don't know. Maybe they buy. What's the chasing thing to do? You buy the high of that bar because you got stopped out there, and so you buy the high of that, and it works a bit. It's a 3-2 up, right? So 3-2 up, that's a 1. That's a contraction day now. And now you have to be worried. So if you're in this situation, you got to be very worried because, once again, we know if you take out this 1, it's going to put that pivot into play. So what happens? The folks who were long here thought it was a good thing because all of a sudden on this day, the 26th, you do get a higher high. Looks like it was going to be a breakout. But as we saw already, it turned to a 3. It takes them all out. Okay. Let's go to the reversal before that. It's a 2 down, 2 up. Simple one here. 2 down, 2 up. Right, 2 down, 2 up. Goes 2 down and 2 up. And so you can see this, just counting the reversals here, you can get quite a few of them, right? So this is why we really need to, and this is the next topic, is you do have to add in a higher time frame so you don't constantly get, whipsawed on these reversals. But what you'll see is once you add in higher time frames, it gives you a lot more context to the charts. Because folks who are looking at just one time scale, they're not seeing the nuance of trading, or at least the participants that are getting involved. All right. So I did the 2 down, 2 up reversal. I did the 1-3 reversal, and I need a 1-2 reversal. Let's see a 1-2 reversal here. I'll zoom in on that one. So that's a 1-2 reversal, right? So nice uptrend. Right, so we have a 1, 2, 3, 4, 5, 6 days of higher highs. All of a sudden, it peaks out with a 1, and then as soon as you break up below that low, there's your 1-2 down reversal, and that's a wrap for that rally. Interestingly, this rally here, if you take a look really quickly, starts here on a 1-3 up reversal, right? So it starts right there, and then this is what I would call a very aggressive move because it's based on this. Outside bar, the 3, right? So 3, 2 up, 2 up, 1, 2 up, 2 up. I call this a momentum move because it starts off a outside bar. So here it's very, as I described earlier, when people get involved with this, it's typically poor price structure because people are chasing here. Some folks got stopped out here, they got very frustrated, they got involved here, and now all of a sudden what happens? Look what happens here. Everyone who got involved in this rally, they got stopped out. Right, so it went all the way down. It basically took out up to, usually takes out that bar. In this case, it didn't do it on that swing, did it? Let's see, low of what? 18,774. No, 18,912. They got stopped out later on though, as we know here already. So, so that's a very aggressive momentum move. And the momentum players often, they always get wrecked, right? It's not always, but most of the time, Like we saw this move here, the momentum move here got faded, right? It got faded. Once you do get a momentum move that breaks, look at this one. Outside bar. So 3, 2 up, 2 up, 2 up, 2 up, 2 up, 2 up, 2 up. Right. So that's a 1, 2, 3, 4, 5, 6, 7-day moves, 7 2-ups in a row. So 7 days of 2-ups in a row. And then finally, when that low cracks, that's a 2 up, 2 down reversal right there. And it fades significantly, right? So if you're getting involved here, more than likely you're going to face some underwater time because you're chasing. And this is why ideally, if you're going to get into entries, you want to get involved early on in the reversal, as early as possible, and not wait till price begins to make new highs. By the time it makes new highs, you're already late because folks are getting involved way earlier than you. So if you can get in around here, thinking that price is going to reverse, then at least you have a bit of downside, right? If you're getting involved down here and trying to short down here, you're late, right? That's what happens. You're very late. So same thing here, right? When you get this reversal, if you get involved around here, it's a better place than getting involved up here when it's already broken above the car bar's highs. Because people always look at this stuff here like, oh, look, this is a horizontal line, right? It's a breakout now. And the breakout buyers, they make a little bit of money, but look, then they get tested, right? And typically they pukes out and they get worried and they end up ditching their trade. So that's the nature of reversals and just the nature of liquidity and markets finding liquidity. So that's I've described all 3 reversal types now. So let's move on to the next topic, and that is layering in now the multiple timeframes, and then we'll have everything we need to do our analysis, and then we'll wrap things up. So let's share out the screen one more time. Okay, and so the final thing to talk about is the multiple time frame analysis. Oh, did I share that yet? No, I did not. Okay. So as you may have seen already, and I haven't shown it yet, but I've been talking about it, is that these patterns, these scenarios, the 1, 2, 3s, and the 3 reversals, work across any time scale or any time frame, and it works across any asset class. It works on crypto, works on Forex, works on stocks. It's just the way that price works. So it's not one of those methods where you have to worry like, oh, is this method going to work, next week, or is it going to work 10 years from now or 20 years from now? The reality is that this is just the way the price works, because this is just an objective opinion of what price is doing. Like, we're not overlaying any subjectivity on it. We're just describing what we're seeing with price. This is why, I like showing this method to people, especially newer traders, because we take out all the bias. We're just describing what price is doing, and the patterns themselves are completely objective. I'm not asking you to find a bear flag or a bull flag or head and shoulders or whatever, all that kind of stuff. This is just pure price action bar by bar. So the final component of this is to layer in multiple time frame analysis. And so why do we do that? The reason we do that is, of course, context. Like I've shown already. Sometimes price can do quick reversals, and if you don't have a bigger picture, then it's easy to get chopped up in those scenarios. But just as important, what timeframes allow you to do is it allows you to see what participants are doing based upon their time scales. So for instance, when I'm looking at a daily chart, people who are typically using daily charts are typically shorter term traders, right? They're either intraday traders who are using the daily chart as a high time frame anchor, or they use, they're swing traders who may be holding a position from, several hours to maybe, maybe less than 2 weeks time. People who are looking at weekly charts, or maybe up to a month, weekly chart traders, people who look at and focus on the weekly chart, that tends to capture folks who are kind of midterm in nature. So their holding period is going to be a lot longer than someone who's going to be a daily chart trader. And finally, monthly. I have a spelling mistake there. It's not monthly, it's monthly. Forgive that mistake. Monthly chart traders, folks who are looking at higher time frame charts like the monthly, the quarterly, even the yearly. Hard to do yearly charts in crypto because we've only been around for a few years, but we do have decent yearly charts now on ETH and in BTC. But the monthly chart typically captures those long-term investors, those folks who want to allocate money for the long term. They're not going to be looking at daily charts, right? If your time frame is, let's say I'm looking at a yearly chart. Let's not, maybe let's go that far, but let's say a quarterly chart. I'm not checking the chart every single day. It doesn't make any sense. My next bar only forms after 3 months, right? So the folks who are looking at quarterly charts, their time frame is in the scale of years and not days or weeks. So by looking at these different time frames, it allows you to see what these different types of investors or traders are doing. So this is, as example, this is what my screen looks like when I'm doing these screens. So depending on what time frame you're operating in, obviously you might want to customize that to try to capture the relevant investors or traders that are active. So you know, I like to bring up the monthly chart, the weekly chart, the daily chart. And if you're doing intraday stuff, then usually hourly is interesting. If you want to go a little bit higher time frame, then you might want to involve the 3-month chart. And as I said before, there really isn't enough yearly data yet on most trading pairs in crypto. So let's put it all together. So let's go back to the charts now, and let's pull it all together, and I'll kind of dissect how I would look at, let's say, the Bitcoin price chart by using this multi-time frame analysis and using our scenarios. So let's share it one last time. Entire screen. Oops, not the one. I want to share just the window. Back to trading view. Okay, there you can see that. So we've already gone through the price action of the daily charts. We don't need to go through that again. But let's begin at a higher level. So instead of looking at the daily chart, let's break it out by the quarterly chart. So let's start at a higher time scale. Usually this is what I like to do, is start on the highest time scale, or one of the highest time scales, and then go down in granularity, because you want to allow the higher time scales to dictate your bias versus the lower time scale. Like, for instance, it doesn't make sense to try to create a bias on a 1-minute chart, right? So if you generally know, like if you look at a higher time scale and it looks like it's a bullish trend, then that's the bias, right? So let's go to Bitcoin, for instance, here. That's Bitcoin telling us right now we're a 1, right? We still have 28 days left in the quarter. It is a 1 right now. That means we're in a range bound situation. And that's exactly what we've been doing. We've been trading range bound for Bitcoin now for the past 2 months. Why is that a 1? Because we know that in Q2, it was a huge down move, right? Now, if we look at the actual Bitcoin chart, look at the quarterly chart, it's very clean, right? You can see we had a 1. This is way back in July of last year, right? So this is Q2 of last year. It goes 1, 2 up. This is the height of the bull market. 1, 2 up, right? So that was the breakout. Everyone's playing the breakout. Remember, we're going 100,000. As soon as it comes back in here, that's a problem, right? It comes in, and now as soon as it comes back into the 1, that's a failed breakout. You have to worry about that. Once you get to the next quarter, though, and you break below this bar's low, that's an actual reversal. So you can definitely get out earlier if you have your spidey sense up and you're like, yeah, we're going to highs, it's a failed breakout. But this price confirms it objectively when it goes 1, 2 up, 2 down, and that's it for the bull market, right? That's a wrap. When we broke below 41,634, that was it for Bitcoin. And as we know now, the first pivot to go after was this pivot here, because anyone who got involved using this chart, their stop is right there, or at least that's, if you're playing tighter, you're going to have a stop at least 29,313, and that's the pivot that people are chasing. And we got that, and we got a little more of that. So now where are we? So we haven't reversed yet on Bitcoin on the 3-month chart, right? So we're still in a bear market, and until we can get a reversal, that means a break above a prior bar high, we're still in a bear market. So this bar does not close until, as I said, 28 days. So no matter what happens in the next 28 days, it's still going to be, in the way I define Bitcoin, and it's worked for my entire existence here in the Bitcoin world, is that Bitcoin works very well on these 3-month cycles. And you can pretty much call bull and bear markets objectively by just looking at the reversals on the 3-month chart. So until you break above, you get a reversal, right? Until you do a 1, so let's say this is Q3, right? Yeah, Q3 ends as a 1, like that, right? The high is going to be 25,205. Let's pretend now we're going to Q4. It's October 1st. Entering the Q4, if you can break above 25,205 in Q4, that's now a bull market. Especially if you can trade above it. Now, if you just peak above and you fall back in again, that's not great. But if you can trade break above and trade above it, the bear market is now over. So that's what I'm waiting for and looking for that to happen. In the meantime, it's just it's just trading, right? You just trade. It's not long-term investing time. Who knows? This could just go 1 here, and then next quarter it actually breaks down even further. You break 18,774, and the bear market continues. But until you get that objective high taken out, right? This quarter's high, next quarter taken out, objectively, price is telling you it's not over yet. So let's do a little bit of a fun look back in time. How has it worked in the past? Well, objectively, it's worked very, very well. Just looking at the price action, right? Going back to this is a Bitfinex chart, so they have pretty old data. Look how it starts off. 3-1. We love that. I love that pattern. 3-1. Let's understand what it is. A 3 is an outside bar, right? So that was 20. Yes, that's an outside bar. So you have a wide range when Bitcoin first starts trading at Bitfinex. Of course, people went crazy. Back in 2013, and it goes 1, 3-1. So now it's contraction, expansion, contraction. What's the next move? Expansion, right? There's your breakout. Boom, huge move back in 2013. Then it goes 1. So a huge range, right? But still 1. Even though that that period had a huge range, it was still a 1. They went 1 again, and they went 1 again. But guess what? Once it broke below that 1, that's your reversal, right? And it does multiple quarters where it does a reversal. 1, 2 down, 2 down. And most people got scared out here because the low was like around 150, 162. Yeah. So there you go. So going forward, was there a next reversal? Right here, you get your 1, 3 up, right? So it goes 1, 3, 2 up. So there's your reversal right there. 1, 3. Then it goes 2 up. There's that move again. Here's your momentum move. 3, 2 up, 1, 2 up, 1, 2 up. No lower lows on the quarterly. This is the bull market, right? No lower lows until when? There. Remember 2018 cycle? There it is. Here's the 2018 cycle. Once it broke below 59.60, there's your bear market. You didn't have to wait that long either. If you look on a monthly chart, you can get out a lot earlier than that. But the quarterly, if you want to be as objective as possible and just work on that quarterly, it's been very good at saying and labeling bear markets, because then you're in a bear market for 1, 2, 3, 4 quarters, right? That's basically the whole year of bear market. It took us from 2018 to 2019. And then 2020, look, there's your 1, 2 up reversal right there. I'll zoom in there. 1, 2 up. That's the start of the 2020 kind of bull market. And it works for about 3 months, right? But all of a sudden, you get a 1. And now you have to watch out. 1, 2 down once again, right? So there, 2020, we thought we were going to get back to all-time highs. It didn't happen. And then this is the one that got tricky, because it did create that cratering low. Remember in March of 2020, right? That's your COVID low right there. It went down to 4,000, basically 4,000 on the dot on Bitfinex. That's interesting. Someone got really lucky and bought 4,000 right on the dot there. And then look what it did. And you had plenty of time to get involved here. 3, and I personally, I full disclosure, I did buy this. 3-1, because we know, if you study history, right? The 3-1 happened here. Range expansion, followed by contraction, and now expecting range expansion again. 3-1, 2 up, and we know that we know the rest of it, right? 2 up, 2 up, and then we know the rest of the story. So that's what you can do with the 3-month chart. So now you get the bigger picture. I kind of went long there, but I'll wrap it up here. So the monthly chart, you can do the same thing. So now you're putting the pieces together, right? You look at the different time frames and saying, all right, the bear market's still telling, well, the 3-month chart's telling me I'm still in bear market. It hasn't changed the bias yet. The bear, it's still going down on the quarterly chart. What's the monthly chart doing? Have we had a reversal yet? Well, here on the monthly chart, we had a 1, 2 up last month, and now we're trading a 1. So we have, we were only 2 days into September. So right now it was 1, 2 up, and this is a failed breakout, right? Because as soon as you popped above the prior bar's high, 24736, it didn't stay very long above that area. 247, and then as soon as it comes back in, it's a failed breakout, and now you're just thinking it's going to be a range bound. That's kind of what happened. Going to the weekly chart now, so we can see what happened on the weekly chart. So how do we know it's going to be a failed? What do we know? How do we know if it's going to be a failed breakout or not, or if the breakout's going to work or not? Because if you're looking at just the monthly chart, you're like, okay, it's a reversal. It's going to go 1, 2 up, and it's going to go back to all-time highs. Is that true? Well, let's take a look and see what the weekly picture is showing us, right? So we know now 24,736 is the area that is the breakout area on the monthly chart. So here, it goes 3-1. We like the 3-1. I talked about it before, right? 3-1 happens right here on Ethereum in August, and it looks like it's going to be a good breakout. It goes 3-1, a 2 up. So it looks like, hey, it's not only are we breaking the weekly high there, we're breaking the monthly high as well. That was the 24,736 area. But what happens here? Remember, it's a 1-2 up. All of a sudden, it goes 2 up, 3 down, or basically, yeah, 2 up, 3 down, and there's your reversal. And so as soon as it breaks below here, there's no reason to be in there anymore, right? Once it gets out of there, you've basically invalidated that setup. At the very least, because you know it's an outside bar, you're going to take out that low there. And that's what happened. Take out that low and it's some extra. Now, if you look at the daily chart, what did that sequence look like? Let's go to the daily now. Here. Remember this area, this big mess that we talked about? This is the place where people are getting chopped up. So now you're seeing, so now you have the bigger context. Some people on the monthly chart think it's a breakout. Some people on the weekly chart think it's a breakout. What are people on the daily chart doing? Unfortunately, going into this breakout, it's bad structure, right? Because we see the outside bar, and this is what, you know, once you get to understand outside bars, you know that these things are very, very fickle, and anything that's based after an outside bar can get very, very tricky because it's range expansion, and range expansion can often lead to very aggressive trading behavior because people are feeling left out or they're feeling the FOMO. So they go outside bar up, reversal here, and then this here is that causes the whole breakdown, that causes that entire rally to fail. So once you get that, that's you know, your signal like this is very aggressive stuff going on here, and you do need to watch out, perhaps get out of there. Okay, so I'll do one final example, then we'll wrap it up. Actually, maybe before I do that, I'll just ask any questions because I know we're over time already at the hour mark. But I'm just going to show ETH because I've spent the whole time talking Bitcoin. Where's my ETH chart? ETH. Yeah, so what do we say about ETH going to the merge? So same analysis. Here's the interesting thing about ETH. So right now, just like Bitcoin, inside quarter, that's a 1, right? The merge is coming out in September 15, 16, and somewhere around there, right? What's the chance that we break this inside quarter? Like, what's the chance we break this 1? It's a 1 now. What would it take to not be a 1? You'd have to take out that low, right? Or take out that high. So you have 28 days left in the quarter. What's the likelihood that this thing somehow breaks above 35.78 or below 881 in the next 28 days? That's the question, right? So that's the question: does it become a 2 up, and all of a sudden you go to get back to all-time highs, goes 2 down, or do you stay a 1? Monthly chart, what's it telling you? Right now, it's, you know, it's a fresh month, so it's not that, you know, we only had 2 days, so it's not giving us much right now. It's only a 1, but you can clearly see you're at risk now of a 1-2 down reversal. 1-2 up, potential 2 down here. Because look here, if I just move this line here, 1-2 up. This is a breakout, right? There's a 1-2 up. People were trying to buy that breakout. It faded back in just like Bitcoin. Now it didn't fade in quite as much as Bitcoin, but now if you break below this low, there's your reversal on the monthly monthly chart. That's not good, right? So that's not good for Ethereum if it breaks below the this bar's low, because it's a 2 down. That's a monthly reversal. Let's say the weekly here, it went 1-2 up, then 2 down. So there's your reversal right there. Went 1-2 up, 2 down, fell back in, right? So as soon as you get that 2 down reversal here, you know they're going to come after this pivot at the very least, and now they're going to go for that pivot. This again is a momentum move outside. So 3, 2 up, 2 up, 1, 2 up. So people who chase this, now they're facing their traditional, you know, retrace. Whether it retraces, you know, 50% or 100%, that remains to be seen, because you still have a strong quarter. The quarter's still green. So there's your, I think I made a lower low this week, right? 1422.80, 1420. No, it didn't. Okay, so this week is still above. It's still, this is still a did it make a lower low? 2280 low. Yeah, it did. Okay, so this is a 2 down. So we're still going 2 down right now. So we got a couple days left in the week. So right now, even though it's a green week, we're looking like it's going to probably be a 2 down on the week, unless somehow it goes above here, and this will turn into a 3 up, right? So it'll be a 2, 3 up. But right now, looking like it's going to probably end up as a 2 down because it's Friday today, and unless something crazy happens on the weekend, we'll probably remain 2 down. And so then, you know, once you put those pieces together, then you can begin to realize, all right, now what's the daily saying? And the daily is telling you it's momentum, right? 3, 2 up, 2 up. Now this thing, you know, yesterday was interesting because you had a slight reversal there, but they buyers quickly step back up again, and we're going back up again. But not great structure here, because you have the outside bar in place there. So one final thing, just to show you that, you know, one last thing, and then we'll wrap it up and open up for questions. So this is what we're looking at on the yearly chart. So Ethan right now is trading a 1 on the yearly chart. So that's a 1. So the question is, right, this is actually a range-bound market. Do we think that it's actually going to take out the last bar's high or low? Because if it isn't, it's going to be a 1 no matter what, right? And that means it's a range-bound market, even though you're getting a big range. And that means as a trader, you definitely have opportunities in this bar, but technically you're a 1. So that means, the only way this is not a 1 is if somehow this year, if people think this is going to be each banner year, do we really think that it's going to go from here back above here and then there with what, 3 months left in the year? Do we really think that? Like, is that really possible? It goes all-time highs in one single shot like that, and it goes 2 up. That'd be very unusual, right? So I think that's a very low probability. So my base case is that doesn't happen. So this is, all we're doing here is, putting together all these possibilities and then trying to create a probability out of it. So the base case is that ETH probably remains a 1 for the rest of the year, even with the merge. But then if you want to play for that, maybe the bear market lasts for several more months or maybe into next year, then maybe sometime next year, or maybe not even. Maybe it's a multi-year consolidation, because right now, let's say it closes here, and next year, 2023, you get stuck in this big bars range. That's another year of consolidation. But at some point, it's going to break. That's why it goes 1, 1, 2 up. There is a potential huge, bull move on Ethereum at that point. Or next year, it breaks above this bar's high. Let's say this is the high for the year. And then you go 1, 2 up. Maybe you get your 6,000 or whatever number people like to call out on Twitter. But same thing with Bitcoin, right? It's really no different for Bitcoin. It's really the same thing. This is why I think bear markets take longer than most people think, because people are looking at the charts. The longer time frame people are like, there's no rush. Like this thing's not going anywhere. Like, look, it's Bitcoin now we had a double. This is this is kind of what Ethereum is doing now, right? We saw that, right? 2 up, 1. That's like kind of what we see right now for Ethereum. Do you really think it's going to break out? You could just do this then for a whole year, right? That was 2019. That's kind of a frustrating year for a lot of people, right? Just kind of we thought it was going to break out, but then it kind of stayed there. And then finally, when it did break out, then you got the huge move. So there's your 1 and 1, a 2 up situation. And then, right now for Bitcoin, doesn't look good because you have a 2 down on the yearly. So no matter what, unless something happens, it can somehow go from here. Like right now we're trading here. It can somehow break above there. That would turn to a 3, but more than likely it's going to stay a 2, right? It's going to be a 2 down because I don't think Bitcoin's going to crack 69,000 with 2 months left or 3 months left in the year. So we're just putting together, all the different Lego blocks here with the different time frames and saying, hey, more than likely the higher times are telling me it's going to be a 2 down on the year. Because 3 up is very, very unlikely. Then you just keep going down the time frames and you begin to, put them all together to try to create for yourself a bias. Because in the end, we all know that, when you trade with the trend, it's a lot easier than trading against the trend. So, let's wrap it up there. We obviously go into a lot more stuff, but I think that's probably more than a mouthful for one brown bag or one session here. So, I'll just close it there and see if there's any questions before we wrap it up. Don't speculate on these patterns until you've practiced many times, because you can get easily whipsawed if you don't apply some of the principles we talked about. Yeah, Jamie.
I just wanted to ask.
Solar.
I just wanted to ask. A lot of indicators and price action indicators, they work better on higher time frames. I was just wondering if this kind of method, is it effective for lower time frames? People are scalping on the 5-minute chart or 15-minute chart.
Yeah. I use this method a lot when I was still intraday trading equities. So you can definitely use this on lower time frame charts. You can go down to the minute. You just have to create your bias properly, right? So you want to basically trade in the direction of the larger bias, and then the principles are all the same, like in all markets, right? Like you want to try to find a bias, right? Mm-hmm. And then look for reversals to get into a position. So for instance, let's say it's a really strong bull market and you want to be a buyer in the bull market, right? So this is going to give you the opportunity to look for reversals on lower time frames to get involved, to buy on pullbacks in a bull market. Likewise, if your bias is telling you it's a bear market across whatever time frame you're working on, then you're looking for reversals to short into, right? So you're looking for spikes to short into, and then looking for reversals then to get into those positions. So yeah, so I think there's a few things that we're talking about here is like using multiple time frames to try to create a bias, and then ultimately you could use price action to help you get into some of those trades. Because all the other pieces that once you understand the 1, 2s, and 3s, you understand that all we're talking about here are these pivot points. What they're telling us is or where there's liquidity, and so like at the very least, like if this bar breaks in 2019, very likely you're going to take out that pivot high because there's going to be liquidity there because there's going to be some shorts that are put their stops there because they don't believe in the breakout. So at the very least, what would you be doing? Like for instance, as an example, as a trading tactic would be you could use a larger bias like this and then use lower time frames for your execution, right? Because this pivot's they're gonna go after that pivot, so you're gonna look for lower time frames to try to take out that pivot. So 17,252 is a level that's probably gonna get taken out. So with a high degree of conviction, you can go on a lower time frame now and say, yeah, that's gonna be my target. So I just need to find the right setup now on a lower time frame to try to take out that target. So at the very least, is going to get there, and then obviously this thing went a lot further than that. But it's a good move here. Like you're looking at from there to there, that's a close to $4,000 move there. Great, once this breakout starts working. So in a lower time frame, a $4,000 move is a huge move. So yeah, you can definitely apply it on lower time scales.
Okay, thanks.
The trick is to try to remove the noise, right? You don't want to get too many signals, so that's the trick. Thanks, Lee. Appreciate it. Hope you guys found it useful. So yeah, the last slide, just to wrap it up, and then yeah, just share the resources. So yeah, Jamie, here's if you want to look at the indicators, then they are there. You go. There's GitHub there. I don't know who this guy is, but I found his stuff on Google, and he had tons of links in there. So yeah, all the indicators are there, and some other information on that. So yeah, don't know the guy personally, but there seems to be a good resource there. So I'll click stop recording here, and that is a wrap. Welcome, Daniel. All right. Thanks, Teresa. Appreciate